Hi, everyone, and welcome to Income Tax Planning and Other Tools in Light of the Coronavirus Crisis. So we're going to talk a lot about income tax planning. We're going to talk a little bit about some other techniques that you can use given the current situation. I'm also going to touch briefly on some of the recent legislation that has came out as part of this coronavirus crisis and in response to the crisis, just to keep you up to date on everything that's happened here recently in the last couple of weeks. One thing to mention off the top here, as I am recording this webinar, St. Petersburg and Pinellas County have issued what they are calling the Safer at Home order. For the most part, it doesn't do a whole lot to restrict businesses. Even if you are a non-essential business, you can still stay open as long as you are maintaining the CDC guidelines of social distancing, having more than 6 feet between your employees at all times. You can remain open for now. We'll see if that order changes. I know Mayor Kreisman has said himself that he would like to have a little bit of a stronger order, maybe apply for St. Petersburg, but we'll see how that develops as the time goes on. So now getting into the PowerPoint here, there's a lot going on. We don't know how this is going to turn out. It could be good, it could be bad. We don't really know, but what we do know is that our clients need more than just legal advice right now. And a lot of clients, specifically to us, they're reaching out and asking, what should I do with my employees? How are they going to be treated if I let them off and let them lay them off? Am I going to be responsible for some sort of sick pay, or how is this all working? So we need to make sure we're well aware of these rules so that way we can advise clients appropriately. There's going to be a lot of businesses potentially go under depending on how long this lasts. So you need to think about ways to structure your entities and think about insolvency and how that's going to affect your planning. Most importantly, don't panic. Stay the course. This will go turn around. And as we say here, we're looking for ways to take the lemons and make them into lemonade. It's important to take care of yourself during this. The better shape that you're in, it's been proven that the less pre-existing conditions you have, the better off you are going to be in the event that you do get the coronavirus. It's important for your mental health as well. Stay healthy, exercise regularly. If you are quarantined, don't just sit around on the couch and watch TV. Get outside, take some walks. That's all going to be allowed under the rules. Make sure we're maintaining good mental health and good physical health as well. So there's been a lot of questions here with everything going on. How are my employees going to be affected if they remain full-time, if their hours are reduced, if they're just a part-time employee? What do I have to provide for them as far as health care goes? Well, you can see here we have a little chart that kind of outlines the requirements here. Alan has a longer webinar on this, but we wanted to provide you with this chart to give you just a brief overview here of the employee health benefit qualification. So if you're a full-time employee, obviously you're going to qualify for health benefits under the Affordable Care Act. Full-time employees defined as a full-time employee that works 30 hours a week on average over one calendar month, or works 130 hours in that calendar month. Now, on the opposite side here, a part-time employee is anyone who doesn't meet those definitions. Additionally, if you are a part-time employee and you actually hit one of those thresholds, so you get the 130 hours in one calendar month, or you get 30 hours per week on average over the calendar month, then you enter into what's called a stability period. So you're entitled to coverage during this period, and that lasts for a total of 1 year. Now, what happens here in our current situation, say we had to take our full-time employees and maybe they're only working half the time that they usually would do. Well, in Alan's interview, this is what they call the downshift rule, and the downshift rule goes into effect, and that averaging that goes and extended out to over a 3-month period. So if you hit 130 hours in one calendar month in that 3 months, or you average 30 hours in 1 month over a 3-month period, you're still going to be deemed to be a full-time employee and entitled to health benefits. Now, on the opposite side, on the part-time employees, same rules would apply, and unless you're in that stability period, then you don't have to provide coverage. You're not entitled to health benefits. Now, what happens if you go into a furlough, which is also known as basically you put your employees on unpaid leave. So basically what that does is it terminates the relationship, constitutes a change in the status of the employment. The employee is required to come off of the health care plan. However, that was all pre-coronavirus. There's some insurance carriers now that are waiving this active work and hourly requirement and allowing the employees to remain on the coverage during these furlough periods or unpaid work periods. Others are just giving 60-day grace periods to allow for coverage to continue, but the employee has to come back to work at some point in time under most of these rules. For your part-time workers, same rules generally would apply. Now, if you completely lay off your employees, they have to come off the healthcare plan. So just a brief overview there of how those rules work, just to provide you with some guidance there. 529 plans. We're in an interesting scenario here where the market has taken a big dip, so a lot of value has been lost under 529 plans. So what can we do with these plans? So one example we thought about is if you have this loss, it may not be worth just sitting around and waiting for this loss to come back up, because really you get no benefit. You have basis essentially in a 529 plan. You can withdraw your basis without paying any tax. There's no accumulation, so there's no tax-free growth. So the 529 plan really doesn't provide a whole lot of benefits. Whereas if you invested more money into the 529 plan, let that grow instead of letting the old plan grow back, the new plan would have growth, which would be tax-free, and it's spent on education. No taxes would be paid on that 529 plan. So just here as an example, you have $10,000 in plan. It drops down to $8,000. You can wait for that to go back up to $10,000 and have, essentially $2,000 of built-in savings, but that doesn't really provide any benefit. You could withdraw that $8,000 now and use it for whatever you want. Whereas if you put $10,000 in the plan, the market goes back up by 25%. You have $12,500 in the plan. That $2,500 is tax savings, tax-free if used on education. So that's just some guidance you can give to your clients or suggestions for 529 plans. Remember that these can now be used not just for colleges, but they can be used for pre-K and high school, public or private. And the nice thing about 529 plans is you can front load up to 5 years worth of gifts into a 529 plan. So assuming we have a $15,000 gift tax exemption, annual exclusion, we can put $75,000 into this plan every 5 years and not have to pay any gift tax. We can use $10,000 of that on education. If it grows at 6% interest, we have $350,000 left in the 529 plan to pay for education when the child turns 18, if you start this when they're born. So 529 plans, great benefit, no gift tax, no income tax, great tool to use. Here's just an article with some more information on 529 plans available by request. If you just want to email us, we can send you this with some other uses for 529 plans as well. Okay, so another new legislation that has passed in response to the coronavirus, it's called the Family First Coronavirus Response Act. And what this does is it requires employers to give their employees 2 weeks of paid sick time for reasons related to the coronavirus. So there's 6 reasons here where this applies, or when employees would qualify for this paid sick leave. One, if you're subject to a local quarantine or isolation order, if you have self-quarantined issues due to the coronavirus, or you actually have symptoms and you're seeking a medical diagnosis, or you actually have coronavirus, you qualify for this sick leave. Now, if you're under one of those 3 reasons, you get up to $511 per day, or $5,110 in the aggregate for the year. And if the employer pays that to you, they receive a tax credit for employment taxes to reduce future employment taxes. So basically the government's allowing the employers to front load this, and then they're going to pay them back in the back end for supplying this benefit to their employees. Now 4, 5, and 6 here is really if you are caring for someone or have a family member that you have to care for, and you personally don't have anything related to the coronavirus, but someone that you're caring for does. then a different set of rules apply. You only get 2/3 of your regular rate of pay, or up to $200 a day or $2,000 in the aggregate. Employers can provide over that amount, but you're only going to receive a credit up to those limits. And then we have, again, the Emergency Family Medical Leave Act. This extends the Family Medical Leave Act. You get up to 12 weeks of unpaid leave. The first 10 days are unpaid. And again, you get a credit for applying this paid leave to the employers under this Emergency Family Medical Leave Act. Some other updates on the income tax front. The IRS originally released this 2020-17 notice that extended the deadline for making payments to July 15th, 2020, and it has also some limitations on the amount that could be deferred. That's been restated and amended by this new notice, which is 2020-18, which now eliminates those caps and also provides that you not only have the extension to pay, but you also have the extension to file. So tax returns aren't due now until July 15th, 2020, and that includes payments as well. Now, here the important part to note, if you live outside of the state of Florida where you might have a state income tax, a lot of states have not came into compliance with this extension. And some states have even issued different extensions. Some states might be May, some states are June. So really look at your state-specific requirements, see how this applies to your state, and make sure you don't miss those state filing requirements, even though the federal filing requirement has been extended. Okay, as we are recording this webinar, Congress is currently debating this new stimulus package. It's supposed to be around a $2 trillion package of benefits to everyone here in America to help offset the cost of this coronavirus. So a lot of this is really just a summary of what we think is going to be in the bill. They've agreed to this in principle. It hasn't been finalized. The text of the bill hasn't been released yet. Nothing's made public yet, so this is just a summary of what we could find, but it's expected to pass hopefully sometime this week. So what the bill's saying is everyone who earns less than $75,000 each year is going to receive a one-time payment of $1,200. Now that $75,000 is based on your 2018 AGI, and also there is a phase out to that. So if you make between $75,000 and $99,000, you're going to get a pro rata portion of that payment. If you make over the $99,000, you're not going to get anything. For married couples, that number's doubled, so the married couple would get $2,400, and the phase out is between $150 and $199. For each child that a couple has, you get a one-time payment of $500 per child. Another part of the bill here is they are allocating up to $367 billion to small businesses to help them keep employees on the payroll. So I think this is really part of that Coronavirus Relief Act that I discussed earlier, where they're going to give tax credits. So a lot of this money is probably going to be allocated towards that, but there may be some additional legislation as well that can provide some credit for employers that are keeping their employees on the payroll. There's also going to be up to $10 million that each business can tap into for a forgivable loan, so they can help them maintain those paychecks. So if that loan is used to pay utilities, rent, mortgage, payments towards the payroll, it's expected that a portion is forgivable. I'm assuming there are going to be some restrictions on this. It's not entirely clear how this is all going to work, but this is just what they are considering right now. They're going to really expand unemployment benefits. They're going to add an additional $600 to those unemployment benefits to help offset this cost of the coronavirus, extend the period of time that you can maintain on unemployment. They're going to set aside a huge amount, $225 billion, to help fight the virus. Those are going to go into public funding to help with tests, to help with hospitals, and the treatment of the coronavirus. They're also considering the bailout of some specific industries. We're not entirely sure which industries that's going to be. Airlines have been discussed. I know there's some discussion of cruise ships as well. So we'll wait to see how that works out and what type of restrictions are placed on companies receiving this money as well. Then another thing that's going to be part of this bill is payroll taxes are going to be allowed to be deferred up until 2021. The Democrats aren't too favorable of this provision, so we'll see if it makes it into the final bill or not. They're also going to allocate a lot of money to your state and local government so they can help locally in the communities. So as I said, this hasn't passed yet as of Wednesday afternoon when I'm recording this webinar. It's expected to pass. The House is hopefully going to pass this using what they called unanimous consent and not have a formal vote. Pass this on to the president and hopefully get this legislation out here in the next day or two. So now moving on to some planning ideas here. Since we've had a change really in circumstances for a lot of our employees, these employees are now working from home. One thing that they might consider is terminating their employment status and becoming an independent contractor. Now to do that, it's more than just going home and working from home. They really have to change their relationship with the employer. And that maybe involves not only working for one person, but also working for other employers as well. So one example here, if we have a really talented paralegal, instead of being laid off, she says, well, let me just work from home. Whenever you have work, send it to me. I'll get it done. I'll do the same thing for a couple of other law firms around here. That paralegal might set up a corporation, an LLC, start working under the LLC, contract with these different law firms, and now become an independent contractor. The benefit here is that employee can qualify for the Section 199A deduction, and it gets you off the hook as the employer for payroll taxes. So this can be a nice planning idea if you can manage to change that relationship appropriately. Now remember, under the Section 199A regulations, there's a presumption that any former employee that becomes an independent contractor is presumed to still be an employee for a period of 3 years if they're still providing services back to their original employer. So we want to make sure that we maintain records to rebut this presumption. The regulations give us some more guidance on that and how these presumptions can be rebutted. For the most part, it's maintaining contracts, keep your partnership agreement, shareholder agreements, really document how this relationship has changed. So here's some factors here that have always traditionally applied. The courts really now look at behavioral control, financial control, and relationship of the parties. So we want to make sure that if we do change these relationships, that we are satisfying these factors and not improperly treating an employee as an independent contractor, because there can be some severe consequences. You can mess up your pension planning. You can mess up your health benefits. The employee could have you be responsible again for the employment taxes, the penalties. So there's a lot going on here. Make sure that this is done properly and seek advice if you are considering doing this. Another big part of what's happening now is you're going to end up having to see a lot of bankruptcy filings. There might be a lot of debt discharged. There's a lot of talk, as I said earlier, of the relief bill providing some sort of loan to small businesses that might be forgivable. It's unclear if forgiven would be treated as cancellation of debt and as income to the debtor who had the debt canceled, and if they'll add an exception to this or not. But remember, if you have debt canceled, it's considered as income to you, unless you have one of these 5 reasons here. If it occurs in bankruptcy, in a reorganization, not considered cancellation of indebtedness income. If the taxpayer is insolvent when the debt is canceled up to the insolvency, it is not considered income. There's qualified farm indebtedness. I'm not going to go too much into detail of that. You also have real property business indebtedness, where if you purchase real property using the trade or business, that debt canceled may not be considered income if canceled. That doesn't apply to C corporations. There's some principal residence indebtedness, but that has expired now, so really this doesn't apply. Now, if you do have debt reduced and it is not considered as income under one of these reasons, you don't just get a free pass. You have to reduce your tax attributes. They call them tax attributes, which is really, that's referring to net operating losses, tax credit, your capital passive loss carryovers, your basis in the property. That has to be reduced by the amount of income excluded under this code section. So just a little detail here on the insolvency provision and how this actually applies. It can be really important when you're considering maybe structuring an entity in these uncertain times as to what type of entity you set up. Now, a disregarded LLC or an LLC taxed as a partnership, you look at the partner level or the owner level to determine the level of insolvency, not the level of the actual entity. So for the most part, these entities aren't going to qualify for insolvency because presumably the partner or the owner is going to have sufficient assets that outweigh their liabilities, or they wouldn't be able to get the loan in the first place. Now, for S corporations, C corporations, you can actually measure that insolvency at the entity level. So if you have a piece of property under an S corporation that has lost considerable value, and then it's foreclosed upon, you have COD income, you can actually look at just the entity, determine there's insolvency, and then exclude the cancellation of indebtedness from income because of the insolvency at the S corporation level or at the C corporation level. Now, for the most part, we really don't want to put real property into S corporations, and here are all the reasons why, except for at the very bottom is that income insolvency exclusion is determined at the corporate level. So, if there's a lot of risk in a property, there may be some reason to put it in an S corporation going forward, at least for the immediate future, given the amount of uncertainty in the market and the real potential that a lot of real estate could see a decline in value like we saw in 08. So now that we have really a break from a lot of business activity, it might be time to reach out to a lot of your clients and say, hey, maybe we need to restructure things. Maybe we need to think a lot more about creditor protection, how that can be done. And a lot of people hesitate because they're like, well, if I have an S corporation and I distribute stuff out of my S corporation to put it in a separate entity, that's going to trigger tax. I don't want to pay tax right now. I want to maintain as much cash as possible. Well, there's ways to do this tax-free, even in S corporations. Just a little slide here on how that works. We call this the new parent F reorganization. What this does is you have the medical practice, or it could be any professional practice or really any type of entity. We just use a medical practice here as an example. So you have your medical practice. It has the practice operations, the equipment, the real estate, the accounts receivable is all under one entity. If something were to happen under there, maybe a malpractice suit, all that's subject to creditors. So how do we separate it out? Well, we set up a new parent, S corporation, that's going to be the owner of the S corporation or the former medical practice. And now that medical practice becomes a Q sub. You set up disregarded LLCs under the parent S corporation, and because we now have that brother-sister relationship with one common owner, we can transfer assets out of the medical practice into those LLCs without triggering income tax. So you can get the equipment out, even if it's depreciated. You can move the real estate out. You can move the accounts receivable out and do a factoring type arrangement. This is all planning that you can implement here, income tax free, that can really help your clients in the future in the event that something catastrophic were to happen. Okay, now moving on to a new topic. Since a lot of businesses may see reduced revenue, and a lot of owners in turn are going to have reduced revenue, they're going to have to pay out of pocket to keep a lot of employees on the payroll. This brings back in Section 199A. A lot of clients, might have had $500,000 of income in 2019. Well, in 2020, that $500,000 could drop down below the 199A threshold and qualify the SSTB or Specified Service Trader business as eligible for Section 199A. In addition, you might have a non-SSTB that didn't qualify for 199A because maybe they didn't pay enough wages or maybe they didn't have enough property. With these reduced incomes, that could potentially result in that company being eligible for 199A. and taking advantage of that 20% deduction. So we wanted to just talk briefly about some planning ideas with Section 199A. The other benefit of today's market, given the decline in value of a lot of companies, Alan recently talked to one valuation expert. He said you might even be able to take up to a additional 10% discount just for uncertainty in the market right now. So the value of the company, if you transfer this out to your children, if you transfer this out to trust for your children, to get your income below the threshold level, and then also allow your child to qualify for the 199A deduction since their income's likely under the threshold level, the amount that you're transferring in that gift is going to be a lot less than it otherwise would have been today, given all of the uncertainty in the market. So here we just have an example of a medical practice. They set up a management company that does marketing and billing and everything besides the actual practice of medicine, so they don't have to worry about any of the restrictions on ownership of the medical practice. The medical practice pays the management company a fee for providing these services, and then we can transfer this management company out to Section 678 trust for your children. That's going to be taxed at their rate brackets and allow qualification for Section 199A, and maybe even reduce the owner's income below the threshold so that owner can qualify for Section 199A as well. Just a little information here on how that actually works under the 678 trust. In order for it to be considered a 678 trust, the beneficiary has to have the power to withdraw the assets from the trust. That power can be released, and then the trust will be treated as owned by the beneficiary, taxed at their individual rate brackets, and potentially allow for the qualification of 199A. We have a Forbes article on how this works and a lot more information on Section 678 trust and their use. In addition to Section 678 trusts, you could also use complex trust to shift up to $157,500 as adjusted for inflation into the complex trust and potentially allow for the Section 199A qualification. The only catch is that if that trust was funded for the primary purposes of avoiding tax under 199A, it can be aggregated back with the grantor for purposes of applying the threshold limitations. So we really need to have other reasons to make this transfer, and right now we have a perfect reason. This is done for estate tax planning because the value of that company has drastically decreased. We want to get it out of the estate while we can at this low value. Not only has the value decreased, but interest rates are at an all-time low. The interest rates right now that are required to be on inter-family transactions are probably going to be less than 1%. The new rates haven't came out yet. They will on any day now. But given that the Fed has dropped interest rates to, I think, 0.25% right now as the target Fed fund rate, those 75/20 rates are going to be extremely low. So we have a perfect perfect reason here to transfer these out without really doing it just for income tax purposes. We also have other reasons as well. So if we can get this into a complex trust, there's other advantages as well from an income tax planning standpoint. Number one is the trust can make charitable distributions. You have to provide language in the trust that authorizes the distribution to be made. But if the trust authorizes this, you can make charitable contributions or charitable distributions from that trust to get a dollar-for-dollar income tax deduction without being subject to any of the AGI limitations that apply to individuals. There's a $10,000 limitation on state and local taxes, but if you set up a complex trust, that gives you another $10,000 limitation. So there's an additional $10,000 of tax savings there as well. You can allocate and spray the complex trust among multiple beneficiaries according to their income. Gives a nice flexibility. 65 days after the end of the year, you can make a distribution and have it apply retroactively towards the previous tax year. So that would give you time to really calculate the income of all the beneficiaries, calculate the income of the trust, then determine how the distribution should be made, since you can spray and allocate accordingly. And then finally, 1041s here have a very low risk of audit. They hardly are ever audited. a lot less than individual returns. We can distribute tax-free appreciated assets out to beneficiaries if we want to do so. And then we can use the older generation. We can give a parent or a grandparent a power of appointment that would cause inclusion in their estate. And the benefit there is that all the assets would then receive a step up in basis to their fair market value, which is another great income tax planning tool, using the exemption of the older generation to help increase the basis of the younger generation. There are some disadvantages of these trusts. There's formation and annual carrying costs. You can't take a Section 179 deduction, but at least until 2023, we have the bonus depreciation rules that do apply to complex trust, even though 179 does not apply. There's some authority maybe that partnership taxation could apply to a complex trust if it holds a lot of business assets. That's never really been, not been a whole lot out there on that recently, but it is a risk. There's also fiduciary duty concerns, disclosure requirements to beneficiaries, again, a tax return that has to apply for the trust. But a lot of these would be offset by the 199A savings if you can get there. Just to close out here, we have a lot of 199A strategies. I'm not going to go through all these, but they're here for your leisure if you would like to review them. And finally, if you have any questions, feel free to reach out via email. My email is listed here. I'll be glad to answer any questions that you might have. We're hoping to do another webinar in the near future once the stimulus package is passed. One of the reasons why we set this one up was to talk about that stimulus package, thinking that it was going to be passed by then. Unfortunately, we didn't get that. So we'll dive into the details as it comes out and do another free webinar walking you through all of the hidden and more relevant stimulus package provisions that come out as a result of that bill. So again, thanks for your time, and everyone have a great day.